Hey all, this is Shubhankar from Concept. Welcome back to another video. So in the previous video of this particular series, we had discussed upon what exactly options are, what are call options. So in this particular video, we will try to discuss what exactly is a put option. So put option is a contract, as we all know, allowing buyer right, not obligation to short sell the underlying. Okay? So it is a type of a contract which is giving the put option buyer right but not an obligation, wherein nobody can enforce the put option buyer to short sell the underlying. Even put options have a specific time frame and a specified strike price, which is also called as an exercise price. The put option, if we buy it, we will only make a profit once the underlying price goes down. So as we do it at Concept, let's try to take a practical example and make the definition as simple as possible. So now we are on our web application and we have opened option chain tool. So wherein we'll get to see the details about all of the strike prices, all of the options, call and put options both, wherein the basic agenda is in between are the strike prices, right hand side puts, left hand side calls. So for this video, we should be sticking at the right hand side part, which is indicating the put options detail. So now expiry date is as simple as that this contract won't be valid any day above 29th of July 2021. So 30th of July 2021, this put option contract won't be valid. What is a strike price? It is an exercise price. Key at what price you are deciding you want the right to short sell Tata Steel's underlying at 850 shares. So to make it simple, these all are the strike prices, wherein let's say in case of 1250 put option, the premium is at 43 rupees. So in this scenario, if you buy this put option of 1250 strike at the price of 43 rupees, you will be receiving a right to short sell Tata Steel's 850 shares at the price of 1250 rupees. Similarly, let's say if you buy a put option of let's take an example of 1300. The premium right now is 74 rupees. So you are getting a right to short sell Tata Steel's 850 shares at the price of 1300. So and simple example how this thing will work is, now let's say Tata Steel's futures is right now 1245 rupees. You bought the put option of 1250 strike at the premium of 43. So now let's say if on the expiration date, which is on 29th of July, if Tata Steel's price goes at the level of 1200, so you are having a right of selling the Tata Steel at 1250 rupees, and basically you are going to sell it at a higher price, and in the market the same instrument is trading at a lower price. So you will sell it at, let's say, 1250 and you will buy it from the open market at 1200. So that difference minus the premium which you paid becomes our profit. So now again, you can't make a put option contract for a single share. It would be at least one lot or multiple of it. So now let's try to identify the impact of movement in Tata Steel's price on 1250 put option, okay, which is trading at 43 rupees right now. Let's say from 5 days down the line from here, Tata Steel's futures, which is trading at 1245 rupees, goes down up till, let's say, 1220 rupees. Okay, how that option is going to trade, how much the premium is going to be, we can see that, we can calculate that. So now 1250 put option is going to trade at 50.99, almost 51 rupees, if the price goes up till 1220 rupees 6 days from here. So straight away we are going to make a profit of 7.99, almost 8 rupees on that particular option. So now if you can see, all of the put strikes have witnessed increment in the premium. So this is the change in premium, and this is what the premium is going to be if you hold this option for 6 days and if the price goes up till 1220 rupees. So you see all of the put prices have gone up. Similarly, now let's say if the price goes up till 1270, okay, and I'll click on update and days remain the same, which is 6 days from here. So you see, if the price of the underlying goes up, our put option is going to give us a loss of 17 rupees and the premium is going to be 25.5 rupees of the strike price of 1250 rupees. So if you want to calculate how much your mark to market loss or profit is going to be, you just need to click on M2M. You will directly get to see the amount into the lot size. So now coming back to the scenarios, so there would be 4 scenarios. The first one is the price goes in your direction. So in put option you want the price of underlying to go down. So if the price goes in your direction, obviously you are going to go ahead and exercise the contract. The second scenario is, let's say the price goes, I would say from 1245 it goes up till 1300. So now you are going to make a huge loss in your premium. So and also you don't want to short sell it where the prices are already high in the market. So you can simply let go the contract. So there is no obligation as such. If you enter a put contract, there is no obligation. You are having a right to short sell the underlying but not an obligation. Third scenario would be, if the situation favors you, if the prices are pretty much the same and if it is giving you a profit, you can probably go ahead and exercise it on the expiration date. Elsewhere, you come to one fourth scenario which all of the participants do, wherein you square off the contracts before the expiration date, wherein let's say if the prices of Tata Steel goes up till let's make it 1260 rupees from here. So now let's say if 5 days down the line from here, Tata Steel goes up till 1230 rupees. So same 1250 strike put option is going to give you a profit of 3.13 rupees. So 3.13 into the lot size is going to be a profit. So you can either square off your position in between. So that's completely your call. There is no hard and fast rule. If you are entering the contract, you should be always exercising it in case of buying a put option. So now quickly summing it up for one last time, what are put options? So put options are opposite of call options, wherein it is the contract is giving us the right but not an obligation to short sell the underlying at a predetermined price, which is called as strike price, which is called as an exercise price. So in this scenario, in Tata Steel, if we are buying the put option of 1250 at the price of 43, we are having the right to short sell Tata Steel's 850 shares at the price of 1250. And if the prices go down in the market, we will buy it back even at a cheaper price. So that gives us a profit. Similarly, the last point is put options, they only give us the profit when the underlying price goes down. If the underlying price goes up, our put option premium will get decreased and that will give us a loss if we have bought that option. So I would say that pretty much was it from this video. So if you have liked the video, don't forget to hit the like button, do hit the subscribe button, so whenever we post something, you will be receiving a notification. Thank you.